Ladies and gentlemen, thank you and welcome back. My apologies for the delay. I know it's been a little while. I had some things on my plate. I just had a kid. Yay! Anyway, what I wanted to talk about, by the way, Z Real Estate. What I wanted to talk about this week is buying a house, and I want to try to help you, the buyer, kind of try to figure out a lot of the stuff yourself in terms of how much is my payment going to be? How do I figure out all the different aspects of the payment, what it is, and whether or not I can afford it? Okay, so we're going to be talking about amortization, PITI, also called the pity payment, which is principal, interest, taxes, and insurance. Those are the four components that make up the entire mortgage payment. Okay, so how do you figure it out? Well, first we'll start with the first two, principal and interest. Now, it goes without saying that if you have an interest-only loan, the first aspect wouldn't apply, principal. So principal and interest means that the payment includes both principal and interest. Now, the reason why that's important to understand is because if it includes both principal and interest, you will not be able to figure out the payment with a regular calculator. Trying to put in the interest rate times the loan amount will give you the interest-only payment, not an amortized payment. In order to get an amortized payment, you either need an amortization calculator, or you can go to Google and put an amortization schedule and get one of their amortization calculators. Now, in order to come up with the payment, all you got to do is take loan amount and interest rate. Those are the two factors to get the payment, okay? So let's say you want to buy a house that costs, say, $600,000, right? And you want to put 20% down. So, how much is the loan amount? Well, the first part can be done with a regular calculator. So, if you put down 20%, you have a loan amount of $480,000, right? You guys with me so far? So with a $480,000 loan amount, that plus an interest rate will be able to help you determine what your payment is going to be. So let's say the interest rate's 4.5%, all right? Let's say we put in our loan amount. Like I said, all you have to do is go to Google, put an amortization schedule, amortization calculator, anything like that. You'll be able to figure it out. Put in $480,000, loan term, 30 years, interest rate, 4.5%, and you will get a payment of $2,432. Now, that payment is called PI, principal and interest. Is it the complete payment, or as lenders call it, the pity payment, which is principal, interest, taxes, and insurance? No. So here's how you get the rest. Now, the actual payment, as I mentioned earlier, the principal and interest, doesn't have anything to do with the sales price. It's based on the loan amount and the interest rate. However, the sales price comes into play when we discuss the latter two, taxes and insurance. Okay, so now I'm hoping you guys have a pretty decent understanding on how to arrive at a principal and interest payment. Now, to attack the final two, it's very simple. Taxes. Take a purchase price, multiply by 0.0125, enter. Good enough. If you want to be exact, contact a realtor. They'll give you some exact ones, but that's close enough. So going back to our example, purchase price $600,000. So 600,000 times 0.0125 equals 7,500 a year, divided by 12, and your monthly taxes are $625 a month. Add that to the $2,483 we came up with earlier, and now we're at a payment of $3,108. However, we're not done yet. We still haven't factored insurance. A lot of ways to do that. The best way is to just call your insurance guy. Give him the details on the house and he'll give you a policy. Take that policy premium amount, divide it by 12, and add it to everything else you got so far. And there you go. You got principal, interest, taxes, and insurance. Another way to do it is to multiply by 0.0035. That's kind of a short way. The sales price. So let's say, going back to our scenario, 600,000 times 0.0035, you get $2,100 a year. Divided by 12, $175 a month for HI, which is called hazard insurance, aka fire insurance, required by law. It's not an option to say I don't want it. It is an option to say I decline to have the account impounded. Impounded meaning taxes and insurance actually included into the payment. Otherwise, it would be principal and interest, which is obviously a lower payment, and twice a year, you got to pay your taxes, and once a year, or twice a year, depending upon how it's done, you'll have to pay an insurance premium. I hope that covers it, guys. Thank you very much for tuning in on amortization schedules, amortization calculators, how to figure out your mortgage payment, and so much more. Next week, we're going to be talking about a little bit more specificity regarding the numbers to kind of help you guys figure some things out. And of course, as always, in the interim, if you need to reach me, www.zrealestate.net, and our phone number, 909-559-5275 is my cell, or our office number, 909-999-6888. Thank you so much, everybody, and have a great week.